The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to Nova's presentation, Introduction to 401k Plans for Plan Sponsors with Charlene DeMartini and Christine Hall. Before we get started, I'd like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions and chat. This is where you will enter in any questions that you may have for Charlene and Christine. Please keep in mind that the Q&A portion of this webinar will be held at the end, and they will answer as many questions as time permits. If time does run out and you still have questions, you can email us, webinars@nova401k.com. Right below questions, you will see a handouts drop-down. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the very end to fill out our pop-up survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce from Nova's Defined Contribution Administration team, Merger and Acquisition Account Manager Charlene DeMartini and Senior Account Manager Christine Hall.
Welcome, everyone. This is Christine, and I just want to thank you for joining Charlene and me today for the next 90 minutes. We are going to be doing an introduction to 401k plans for plan sponsors. So my hunch is a lot of you out there probably have a brand new 401k plan. So I want to congratulate you on that, and hope that it is an exciting new benefit for you and your employees. Before we get started, I just have a few housekeeping items to do. Here's our disclaimer. The information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional such as an attorney or an accountant if you need legal or tax advice. Are you here to get CPA credit? If so, here's Nova's provider number. Make sure that you registered for the webinar individually. You have to be in the seminar for the entire time, and at the end there's going to be a pop-up with a form for you to complete. That's how we'll also know that you're here, and then you'll get your certificate within 1 week. So we have a big agenda today because there's a lot of things to talk about with 401k plans, and here's an overview of where we're going to go today. We're going to talk about the roles and responsibilities in a 401k plan. We'll touch on Nova's cybersecurity measures. We'll talk about 401k basics, the moving pieces in a 401k plan, distribution basics, loan basics, and then finally wrap things up with an annual calendar so you'll have a good idea of what your year will look like with your 401k plan. So starting out with roles and responsibility, you'll see this graphic here shows 4 different parts, 4 different groups that have responsibilities in a 401k plan, because there are, some complexities to 401k plans. So it's split up into 4 different groups so that your plan can best be serviced. And we're going to start right here with the plan sponsor. And the plan sponsor is you. It's the company that is sponsoring the 401k plan. And the plan sponsor has the overall fiduciary responsibility for the plan. They are responsible to communicate the plan to their employees and responsible to remit payroll contributions that those employees make to the record keeper. And they also are responsible for providing the TPA or third-party administrator the annual census data that's needed to do the required compliance testing. Then right beside the plan sponsor is the financial advisor. Sometimes that person's also called a broker. And their role in the plan is to assist the plan sponsor with the selection of the vendor or investment provider, and also to monitor the funds that were selected for the employees to invest in that plan. The financial advisor will help the plan sponsor to coordinate enrollment meetings for employees when they become eligible for the plan. They'll provide ongoing investment education when the employees might have questions about how they should invest their money or if they're invested appropriately in the plan. And they'll assist the plan sponsor with being 404C compliant. And that means that 404C compliance means that the plan has a good mix of different types of assets so that an employee has an opportunity to have a well-diversified investment option. And then the next person right below plan sponsor is the investment provider. That is sometimes called the record keeper as well. And that is the custodian that holds the plan's assets. So it's a financial institution. The investment provider invests plan contributions and provide daily record keeping for the plan. So these plans are valued on a daily basis, and your employees can log into the investment provider's website and see their plan account on a daily basis. The investment provider is also responsible for providing participants with statements. And these statements, depending on how the participant elected to have statements received, could be mailed to them or sent to them electronically. And those statements will be provided at least once one statement each quarter. Sometimes it's more frequently. The investment provider is also where the employee goes for distribution, withdrawals, and where the plan sponsor can get information for reporting, and the TPA for different reporting, like the Form 5500. Then finally, we have the TPA, which stands for Third Party Administrator, and that is NOVA's role in your plan. And as a third-party administrator, our responsibility is to prepare and maintain your plan document. All qualified plans are required to have a plan document, so we'll make sure this is in good shape and compliance for your plan. We also complete the required annual testing, and we'll be going into that more in this presentation. And we prepare the required annual filings for your plan. Mostly that would be the Form 5500, and there could be some other filings that would come up, but the Form 5500 is required on an annual basis to be filed, and NOVA will prepare that for you. And we'll provide ongoing plan consulting. Once your plan is set up and ready to go at NOVA, you will be assigned an account manager, and that is the individual that you want to go to whenever you have a question about how your plan should be operating, provisions in your plan, and that individual can provide you with help. And if they're not the right person to go to, they can direct you to the person who is. Now, before we get into the nitty-gritty with 401k plans, I do want to go over NOVA's cybersecurity measures, because in our world today, it is just such an important thing. You can't be careful enough with electronic data, and on an annual basis, you're going to be asked to provide census data to NOVA, and that has a lot of confidential information in it, like your employee's name, social security number, date of birth and address. So it's everything that if a bad guy could get his hands on, to do fraudulent things, he would be happy to. So with 401k plans, there's a tremendous amount of money involved. So bad guys are looking to get this information. This might not just be looking at NOVA. If the proper information is gotten, coordinated attacks can happen on the record keeper. And it might not just be from the census data that NOVA that you're providing to NOVA. It could start with a phishing attack or a hack in an employee's email. After that happens, the attacker then contacts the record keeper where the money is held and resets the password. And with the new password, the hacker can request a loan or distribution. And that quickly, just because an employee wasn't aware that they were sent a phishing attack, their money from their 401k plan could be withdrawn. With ACH and wires, typically only trivial amounts are recovered when the theft is discovered. So we want to be very careful with this sensitive information. This type of theft isn't covered by the plan's Fidelity Bond, fiduciary insurance, or E&O insurance. So we all really do need to be alert and do our part to prevent fraudsters from succeeding. Like I said before, the census files and deferral files, which are the contribution files, payroll files, and address files, all have sensitive information. Other sensitive information that NOVA is going to provide back to you is copies of non-discrimination testing. And the non-discrimination test, I have them listed here, the ADP test, the Topheavy test, the 415, 402G, and 401A tests all have employees' information in them. So we're not going to send them to you through regular email. We have a plan sponsor link that will send them to you. Now, with email, most software does mask Social Security numbers now, but some don't. So you don't want to take a chance by ever sending Social Security numbers through regular email. Some plans also require annual valuation reports. And again, those will never be sent to you through regular email. They'll be posted out on our secure site for you to access. There will be times where NOVA might need you to provide us with a copy of your tax forms, whether it's W-2 forms, K-1s, or Schedule Cs. All of those forms have Social Security numbers on them, names, and other information. Please do not send them to NOVA through regular email. You'll want to use our secure file exchange on our plan sponsor link to send them to us. Or if you have to send them by email, make sure it's an encrypted email. Never ever send this via an email without encryption. Now, I had mentioned several times NOVA's plan sponsor link, and that's our secure web portal. And there's a link right there. But I am sure too that as your plan gets up and running, you're going to hear a lot from your NOVA account manager about our plan sponsor link and how to use it. There's also a secure file exchange that allows you to send things to us and us to send things to you. We do take cybersecurity very seriously at NOVA, so we use encryption in our software. As far as getting access to the plan sponsor link, no one can just reach out to your NOVA account manager and say, hey, I'm new at such and such a place. Can you please add me as a contact? No, that won't work. All new plan contacts must first be authorized by an existing contact before being added to our system. Because when someone's added with full access to Plan Sponsor Link, they have all that census data, annual census data that was submitted to NOVA available to them as well. NOVA employees have mandatory training every quarter so that all of us are, up to date and being aware, looking out for things so that we don't put the sensitive data that we work with at jeopardy. And NOVA also has a password policy where all passwords are changed at least every 90 days. So again, please use the census upload function on Plan Sponsor Link to submit all your annual census data to NOVA. Use the secure file exchange on Plan Sponsor Link to send us other sensitive information like K-1s or W-2s. Limit the number of people that are copied on emails that might have sensitive information with them. And also, when you choose a password, make sure that it is complex. As you can see, how password was written there in a complex way. And be sure to change them often. And that way, we can all be sure that we're doing everything we can to keep employees' data safe. So now that you know what NOVA does to make sure that your data is safe, I want to go into the basics of 401k plans. So a 401k plan gives an employee an opportunity to save for retirement on a pre-tax basis. And it's really set up to be simple and easy for employees. An employee just needs to make an election of what percentage they would like to contribute to the plan. That's communicated to payroll, and they also need to make an investment election, and then they're set. And it's really important to employees because for most people, their 401k is their biggest asset outside of their home ownership. It's the primary retirement plan for most people. And like I said before, because of all this, it really is a valuable employee benefit. Now, even though 401k plans are designed to be easy for employees, it's not necessarily designed to be easy for the employer to administrate. 401k plans are heavily regulated by both the IRS and the DOL, and sometimes common sense thoughts on how the 401k plan might run doesn't always help. IRS and Department of Labor rules frequently change, and you need to make sure that you're using your plan's written document when you're making decisions about how your plan should be run. The IRS, how they relate to 401k plans is they want to make sure that your plan is in compliance with federal statutes and IRS regulations. And how this is done is through non-discrimination testing. There are a series of tests that are required to be done on your plan on an annual basis in order to show that it is not discriminatory towards highly paid employees. They also look at taxable events that happen in a plan, and they also look at the deduction limits to make sure that those are not violated by the plan. The plan document is very important to the IRS because that is your written document that states how you should be running that plan. And so as different laws change, the plan needs to be amended, or if you change how you want to run the plan needs to be amended And so the IRS is going to look to make sure that that plan document is amended on a timely basis. And they want to make sure that the terms of that plan document are followed. The Department of Labor, on the other hand, looks at plans a little bit differently than the IRS does. They are looking out for your employees. They want to make sure that employees are being treated fairly and according to the plan. And so one of their big things is to make sure that 401k contributions and loan repayments are deposited timely. They look at the fund lineup and make sure that you have fund options that are prudent. They'll look at the expenses that employees are required to pay from the plan to make sure that they're reasonable. And they also look at the annual Form 5500 because that is required to be submitted to the Department of Labor. So a little bit back, I did say that sometimes 401k plans don't always seem to go by common sense. And so I have a couple examples to show how that could be the case. So in this first example, the plan sponsor wants to exclude hourly employees from his plan. That seems to make a lot of sense. And, you know, as long as you're doing that fairly, you might think, sure, I can do that. But before you do that, there's a couple of things that you need to keep in mind. First, the plan document needs to also be written to exclude hourly employees. Never make an assumption that something's allowed in your plan by your plan document without making sure that it is. And if you can't easily find it in the plan's adoption agreement, reach out to your NOVA account manager. Then the other thing might be that the plan has to be able to pass IRS coverage testing. So by excluding hourly employees, are you still able to pass that testing? Maybe not. So you want to check with those kind of things before you make any changes on how you do things to the plan. In this second example, I have the question here: what is the preferred investment alternative for an employee who puts money into a 401k plan but fails to make investment selections? So here you have someone who signed up to make 401k contributions and either didn't make an investment election, or maybe never signed up to make 401k contributions, but let's say they receive a profit sharing contribution, but never made an investment election. So what do you do with that money if they never made an investment election? Well, according to Department of Labor regulations, the money needs to be defaulted into a balanced fund or a lifestyle fund. Now that can go counter to common sense, because you might be saying, well, shouldn't it be invested in a money market or a stable value fund so that, you know, it would be like putting it in the bank and wouldn't have, you know, a big impact until the employee decides to make an election. But that is not the case. Money market and stable value funds do not meet the Department of Labor's requirement of being a balanced fund or a lifestyle fund. They want it to be in a fund so that if the employee never makes an investment election, that over time that money has an opportunity to grow and hopefully at least keep up with inflation or possibly exceed it. Now, the timely deposits of 401k contributions and loan repayments. And I brought that up, that is very important to the Department of Labor. So the rule is different slightly for small plans versus large plans. So we'll first look at small plans. A small plan is a plan that has less than 100 participants with account balances. And yes, I did say account balances and not just participants, because if you did have a little prior knowledge about qualified plans prior to 2023, you actually determine it on the number of participants, even if they didn't have an account balance in the plan. So now in 23, we only need to count them if they have an account balance in the plan. So if they're under 100 participants with account balances in the plan, they're considered a small plan. And in 2010, the Department of Labor issued final regulations that says that those contributions need to go into the plan as soon as administratively possible, but no more than 7 business days after the date they were withheld. What is really important here that the Department of Labor ideally wants is for you to making those employee contributions to the record keeper part of your payroll process, so that when you're processing payroll, at that same time, you're making the deposit of the employee's contributions to the record keeper. Now, for large plans, that is a plan with more than 100 participants with account balances. The rule is slightly different. It's as soon as administratively possible. And then there's an old clause that says, and within the 15th business day of the following month. Well, the Department of Labor never really updated that, but I will tell you that's not really what they want. Occasionally I will have a client that brings this up to me, and I always advise them to not go by that, because the way things are done so electronically nowadays, I would find it very difficult to convince the Department of Labor that the 15th business day after the month following that the contributions were taken from the employee's pay is as soon as administratively possible. For large plans, they didn't provide a number of days like they did for small plans. But I would say, as a best rule, it should probably be within 3 to 5 business days after that pay date. But more than anything, the Department of Labor is, again, looking to see if it's part of your payroll process. They want to see a pattern forming that you get paid on this date, the deposit goes into the record keeper on this date, and they really don't want to see many days variance in that. It's a huge issue in Department of Labor audits. And in fact, with large plans that are required to have an annual audit by a CPA, they look for this too because of how big of an issue it is with the Department of Labor. And if they see outliers, even if it is within 7 business days or that 15th business day of the month following, they'll often recommend that a correction's made for late deposit on that pay date. Now, I've been bringing up the Form 5500, and so we're going to go into that a little bit more. It's an annual report for the plan. You can think of it almost like a tax return, but 401k plans are not taxed. So it's not a tax reform, but it's similar to a tax filing, and it is required to be electronically filed with the Department of Labor. The information on the Form 5500 includes the participant count, the fees that are paid by the plan's income statement, and the plan's financial statement. It is all at the plan level. It doesn't have any participant-specific information on it. In fact, because it's at the plan level, it is publicly available on the Department of Labor's eFast website. So anyone that would want to go in and look at your plan's 5500 that's been filed. One of the things that must be reported on the Form 5500 is the plan's Fidelity Bond. So if you don't have a Fidelity Bond for your plan, you want to make sure that you have one, because the Department of Labor will see whether or not you have one. And if you have a large plan, an audit report will also need to be attached to the Form 5500. And again, a large plan is a plan that has more than 100 participants with account balances. There are transition rules in what is considered a large plan. So as soon as your plan hits that 100 participants with account balance mark, that doesn't mean that your plan's going to immediately be a large plan. The counts always looked at as of the beginning of the year. And the transition rule is that any plans between 80 and 120 participants. So if a plan's a small plan, it'll remain a small plan until it reaches 120 participants. So that gives plan sponsors some time, to recognize, hey, I hit that 100 mark, I'm getting close. An audit's going to be coming up. Likewise, if a large plan wants to remain a large plan because maybe they just dipped under 100 for 1 year and it doesn't make sense for them not to be audited, they can still receive an audit until they reach that 80 participant mark. Okay, next we're going to talk about payroll integration and what it is. So payroll providers submit full census data each pay date to the record keeper. That's ideally what you want to happen so that the record keeper is up to date with everything and that the information on their website that your employees are seeing is accurate. And that information is going to include addresses, dates of birth, dates of hire, dates of termination, compensation, and the deferral data. And it should include all employees that were paid on that pay date, even if they didn't make 401k contributions to the plan. So you can see the record keeper needs a lot of information. So if you can have the record keeper and your payroll provider work together, it could make things easier for you. If your payroll is integrated, your annual census data could be pulled from the record keeper. It will allow automatic distributions to participants. So once a termination date is received in the census file, then the vendor or that record keeper will send distribution packet to the participant. And if that participant has an account that's under $5,000, the participant will be forced out if they don't respond to the request, usually within 30 to 45 days after the request is sent. So that'll help to keep your plan from not having small accounts hanging around. It also allows vendors to keep track of enrollment so that when you have a new employee, the vendor will send out an enrollment packet to that employee once they are close to meeting the eligibility requirements. And you'll also be, like I said before, updating things like address changes, dates of rehire. So there's two types of payroll integration, and the one that's probably the preferred one is called Payroll 360. And that means that your payroll provider gives information to the record keeper, and the record keeper sends information that they collected from the employees, like deferral changes, back to the payroll provider. So that is really the most hands-off setup to be had. There are some record keepers that they are not set up to take the data both ways. But if you are working with a record keeper, it is certainly something that you want to look into in order to save you time. If they're not set up with Payroll 360, they might be set up with Payroll 180, and that's a one-way flow. So your payroll provider will provide all that information on a payroll basis to the record keeper. The record keeper won't send back employee deferral changes to the payroll provider. Most of the time what they do is they will let you know as plan sponsor, and then you'll need to update your payroll. But that is still better than you as the plan sponsor having to each payroll upload that file to the record keeper. So two things that you want to look into to see if your record keeper and your payroll provider can work together in either of these ways. All right, so we want to talk about non-discrimination testing a little bit next. And the first test we're going to look at is the ADP testing, and that is average deferral percentage testing, and that compares the amounts of the deferrals of highly compensated employees to the amount of the deferrals of non-highly compensated employees. And generally, the test will pass as long as the highly compensated employee average is within 2% of the non-highly compensated employee average. So, who is a highly compensated employee? And we often will refer to highly compensated employees as HCEs. So if you hear me say HCE instead, that is highly compensated employee. So for 2023, any employee who earned more than $135,000 in 2022 is a highly compensated employee for 23. And that compensation amount does adjust on an annual basis. Also, anyone who owns more than 5% of the company is a highly compensated employee, and that is regardless of that person's compensation amount. Also, if lineal family members work for the company or the spouse of the owner works for the company, they are attributed that ownership and would also be considered highly compensated employees regardless of their compensation amount. Another test that needs to be done is called a top-heavy test, and that looks at the actual balances of another group of employees called key employees to make sure that the key employees' balances are not more than 60% of the total balances. If that would be the case, the plan is considered top-heavy, and the employer would be required to make a contribution for non-key employees. A key employee is very similar to a highly compensated employee. Similarly, if you are a greater than 5% owner, you're considered a key employee. But here it gets a little bit different. A 1% owner with compensation greater than $150,000 is also considered a key employee, or an officer of the company with compensation greater than $200,000 is a key employee. And then for that ownership, similar to HCEs, any lineal family member or spouse that also works for the company of a 5% owner is also considered a key employee. Good news is, if you were listening to that ADP testing and top-heavy testing and thinking, oh no, my group is not going to pass those tests, there is an option available. It's called a safe harbor plan. And if you follow the rules for the safe harbor plan, your plan's set up that way, you are exempt from the ADP and the ACP test, as well as the top-heavy test. A little bit more about safe harbor plans. There are two different types. Your plan can either be a safe harbor plan through a safe harbor match, the basic formula being 100%, a match being 100% of the first 3% deferred by employees plus 50% of the next 2% contributed And there are some alternatives to that as well with the match if you would like to change that a little bit, but there's definitely rules that of what it needs to at least be. The other option is a non-elective contribution, which is independent on if the employee chooses to contribute to the plan. And that would be to give all eligible employees a 3% of pay contribution. These safe harbor contributions need to be 100% vested. Now, besides the ADP test and the Topheavy test, there are other testing that needs to be done, even if your plan is a safe harbor plan. And some of those tests are coverage testing, and that looks at the numbers of employees contributing to the plan, comparing the number of highly compensated employees that are benefiting in the plan to the number of non-highly compensated employees who are benefiting. There's also additional testing that needs to be done when a profit sharing contribution is made. And there is testing on compensation. If your plan uses some kind of definition of compensation other than just regular W-2 compensation, if there's some exclusion, there's also non-discrimination testing on that. Like I said before, it is important that your plan document is amended timely so that you stay current with new legislation. Typically, the IRS requires all plan documents to be restated about every 6 years. So NOVA will help you go through that process. Amendments need to be executed timely, and there's penalties if you fail to do so. Your plan document has the rules for your plan. It defines eligibility rules for your plan, what the entry dates are, how compensation, eligible plan compensation is defined, the employer contributions that may be made to the plan, as well as the vesting rules for your plan. So if you'd ever want to change that, you want to reach out to your NOVA account manager to see if an amendment can be made to your plan. I want to go over some common plan sponsor or payroll errors, because if you're new at this, you want to look out for these, because these are things that we often see at NOVA and want to try to prevent you from falling into. Excluding bonuses from deferrals. Unless your plan excludes bonuses from plan eligible compensation, deferrals should be taken from bonuses. Excluding part-time employees from the plan. You need to go by the plan's eligibility rules. Sometimes part-time employees meet the plan's eligibility rules and should not be excluded from the plan. Matching catch-ups separately from non-catch-up contributions. You want to look at deferrals in total. So you'll add together the catch-up contributions and the deferral contributions for that payroll period and then calculate the match. Similarly, if an employee is making both traditional 401k contributions and Roth contributions, you want to add those two amounts together and then calculate the match. The match should never be calculated separately, because that will cause that individual to receive more match than he or she should receive. Not distributing the summary plan description. You want to make sure that that summary plan description is distributed to everyone and all new employees who will be eligible for the plan. Not allowing new employees to participate in the plan. If an employee meets the plan's eligibility requirements, you need to allow them to participate. And not capping match contributions on the annual compensation cap. The annual compensation cap for 2023 is $330,000. So you'll need to cap it at that. So here's an example of not allowing participants to enroll on time. ABC Company's plan has no age or service requirement. So that means they have immediate eligibility, but does not offer Steve enrollment into the 401k plan for 6 months. So in order to correct that, ABC Company will have to make Steve whole by making an employer contribution for the missed deferrals and employer match during the time that he wasn't allowed to be in the plan. And then here's an example of not properly capping the matching contribution. In 2023, if the matching formula is 50% of the first 6% of compensation that an employee chooses to contribute, then the maximum match that any one employee could receive in 2023 is $9,900. How did we get that? Well, like I said earlier, the compensation limit for 2023 is $330,000. If we multiply that by a 50% match, and then also by on the first 6% of compensation, that's how we get $9,900. So no one's match should exceed that. So for your higher paid people, you want to keep a close eye on that so that you don't create an excess match contribution that needs to be forfeited from their account. Initial eligibility in the plan. So no plans can require a wait period that's longer than 1 year and age 21. That is the minimum, the maximum wait period that's allowed. And you have to have at least 2 entry dates. A certain number of hours can be required to accrue in that 1 year, but it can't be more than 1,000. So you can require that a person works at least 1,000 hours in a year to enter the plan. So as you see, you can't exclude part-time employees because you might have a part-time employee who works more than 1,000 hours who would be allowed to be in the plan. And age 21 cannot be exceeded. You can have shorter waiting times or shorter age time. That's okay. And the initial computation period is a 12-month anniversary from the date of hire, and then typically changes to plan year. And I'll show you how that looks on this slide. Let's say you have someone that was hired on June 1st of this year. Their first year of computation period would end on June 1st of 2024. If 1,000 hours was worked during that time, they would enter into this plan that has semi-annual entry dates on July 1st, 2024. Now, if 1,000 hours was not worked during this initial computation period, then for subsequent periods, we'd be looking at the calendar year. So the next computation period would be from January 1st, 24 to the end of the year, December 31st. And if 1,000 hours is worked, that individual would enter the plan on January 1st of the following year. So in this case, January 1st, 2025. Another thing that we need to be careful about with 401k plans is dealing with rehires. And this can be a tricky situation because every rehire situation seems to be a little bit different situation. So if you're ever not sure or just want to have that full comfort level, reach out to your Nova account manager when you have a rehire situation to make sure that you're handling the person correctly. But here are the general rules for you to keep in mind. So if a formerly eligible employee, so that's someone that was in the plan, ever had a single vested dollar in the plan, he or she never loses their prior service credit. So once in the plan, always in the plan. So if they're in the plan, had money in the plan that was vested, and they leave, and then even if they were paid their account when they come back, they are immediately eligible for the plan upon their date of rehire. So you want to make sure that they have that summary plan description and information on how to contribute to the plan on day one. Now, otherwise, if that wasn't the case, that they didn't have money, you weren't eligible and didn't have money in the plan, an employee would lose their prior service credit after 5 consecutive one-year breaks. And again, you need to allow rehires who have not lost their prior service credit back in the plan immediately on their date of rehire. That's really important. So if you know that you're going to be rehiring someone, you want to look, to see, did they ever meet the plan eligibility requirements before? And if they were in the plan before, they need to be immediately in. And next, we're moving to the moving pieces in 401k plans, and I'm going to hand it over to Charlene.
Thanks, Christine. Just give me a second here to show my screen. Can you see that, Christine?
I sure can.
Awesome. All right. So as Christine mentioned earlier in the presentation, you have several companies involved in your retirement plan. And this second slide here, in addition to her initial slide, shows a little bit of more detail of what those entities are responsible for. And so part of the presentation today is going through those moving pieces to tell you who is responsible for what, and just trying to get you to have a sense of where to go with what you need for your plan. You can always reach out to your account manager here at NOVA if you have any questions, but just to give you a little brief summary of what to go to. So as Christine mentioned a little bit of this earlier, your record keeper is the keeper of the money. They are the investment portfolio for the participants to invest in. They track the investment transactions. They will have the reporting that you can pull for yourself and for the participant to show the activity in the plan, any changes that have occurred in the participants' accounts, withdrawals, any of those types of activities, and also provide education and communication for the participants for their funds and how the plan operates. On the flip side, on the right side here, we have the investment advisor or financial broker. They will be able to have client relationship with you to discuss any of the fees of the plan, any offerings that you have as far as funds, and consult on those and complete an annual review to go over those items with you, as well as be able to help with enrollment for participants to educate them on the funds available and the rules for the plan. And then again, we have the third-party administrator in the middle here, which is NOVA, and we're completing the compliance testing consulting, help you design the plan and draft the plan documents, as Christine mentioned, that houses the rules of the plan. We will help with distribution and loan processing to help you decide if a participant is eligible for a distribution, or maybe what the alternative can be for them to take a distribution, and also help with the government reporting and disclosures of the annual 5,500 that's required each year, and possibly Form 8955 SSA may be required as well. So again, there's a lot of moving pieces that we just want to go over some of the items that come up quite often to let you know who's responsible for those. The first and foremost is just how the money gets to the record keeper. Most record keepers, which are the holder of the money, provide a secure website for you to be able to upload the contribution information. So typically what will happen is you will get that data from payroll, provided into a format for the record keeper. Usually they can provide an Excel file that you can upload, or if you have a small enough company, be able to manually enter that data. If you go, I would say more than 10, 15 employees, you'll probably want to have an Excel file that you can upload. Just human error, you might have a typo and not want to enter all that information and take that opportunity for an error to occur. But again, that information can typically be uploaded to the record keeper, and then they'll keep track of that money by source. So as Christine had mentioned also, there was several items that you can contribute to a plan: a pre-tax salary deferral, traditional deferral, Roth deferrals, safe harbor contributions, matching contributions, rollovers, profit sharing. There's a multitude of sources that can be used. And so when you upload that data to the record keeper, you'll have that indicated in which source you want to have those provided to, and then the record keeper will track it thereafter with any earnings or withdrawals that happen with that money as well. Who calculates employer matching contributions? So this can be either yourself or NOVA. If you are depositing pay period by pay period and contributing the match pay period by pay period, that's going to be either calculated by your payroll company or by yourselves when you have that payroll data available. If you would like, we could contribute or calculate rather that match for you on an annualized basis. Some clients would like to just have one deposit per year and not to have to worry about calculating the match, and we can do that for you. Each year we receive that census data, we can calculate the match for you at that time and provide a spreadsheet by participant so that you can upload that to the record keeper. But alternatively, a lot of clients like to have those monies deposited pay period by pay period, because the participant can see that money going in, and it's more of a the participants like to see that money going into their account every pay period rather than wait to the end of the year and see an annualized match. But it's really up to you and how your company operates, but we can do either one and help you with the calculation of those contributions as well. Who's responsible for preparing the 5500? Again, the 5500 is an annual government return that's required to the Department of Labor every year. And unless there's a special engagement, NOVA is going to be preparing that 5500 for you. We will provide that in a draft form, signature ready draft form, so that if everything is okay after you've reviewed that, you can click on the link that we would provide and electronically sign that 5500 and submit it to the Department of Labor. It is required to be electronically signed. That's a Department of Labor regulation, and we can help you get those electronic signing credentials from the Department of Labor as well. How does an employee get a distribution paperwork upon termination of employment? We suggest that you give out those distribution forms. Typically, they're provided by the record keeper. So for instance, if you have John Hancock as a record keeper, that form can be provided to the participant as you're doing their exit interview. So with their COBRA notices or any other items that you're giving them at the exit interview, we suggest giving that paperwork at that time. It's just fresh in the participant's mind that along with their COBRA insurance and things like that that they're completing, they can go ahead and complete that distribution form and have those funds rolled to wherever they would like to take that money to. We do have a service where we can mail this information to employees, and that's upon request, so just talk to your account manager about that. Notices. There's going to be a bunch of notices that may be required for your plan, and who's responsible for distributing those notices. For the most part, it's going to be you as the plan sponsor. We do have a service provided under our sister company that can help you with that, and we'll provide that on another slide. But there's several notices that are required. The summary plan description, which I know that Christine had mentioned, that's more of a layman's term booklet that can be provided to the participants or must be provided to the participants, showing the rules of the plan. And again, that's required for every newly eligible employee, and then also for anyone, anytime there's a change for the changes in the provisions of the plan, that summary plan description would need to be redistributed. The summary of annual report, the SAR is a consolidation of the data that's provided on the 5500 to Department of Labor. This summary annual report is required to be distributed to participants as well. Special tax notice. The special tax notice is a notice to the participants letting them know what the tax ramifications are for which distribution option they choose when they decide to take a distribution. Almost always now that special tax notice is attached to the distribution form, but if it isn't for any reason for the record keeper that you're using, you'll want to make sure that you have that separate special tax notice that the participant will receive with the distribution forms. The annual safe harbor notices, as Christine mentioned, there's an option to add safe harbor provisions to the plan. And in doing so, that does require an annual notice that needs to go to participants no later than December 1st of the year preceding the election. So if you're going to be a safe harbor plan for 2024, that notice will need to be distributed to participants by December 1st, 2023. The annual 404A5 fee disclosure notices. That's a big mouthful there. That disclosure notice is describing the fees of the plan and the different fund options that are available in the plan, maybe distribution fees, loan fees, those types of things. That's required to be distributed to participants as well. Some record keepers do distribute this as well as the statements to participants. So it would just be dependent on your record keeper if they provide that service or if you will need to be providing that to the participant. And then last on this list is the annual automatic enrollment notices. Some plans provide an opt-out option for the plan rather than opt-in, so that if a participant doesn't complete a deferral election, they would be opted in at a specific percentage. If you have that feature in your plan, there's also a notice that's required each year as well. And here's that information I let you know about our sister company, AFS. They can provide these notices to participants. There is a fee for doing so, and it's usually a flat fee and then the mailing fees. But if you have quite a few participants, this is usually very beneficial to our clients to be able to get that off your plate. So I'm just going to give a second for you to write that down if that's something you're interested in. If not, at this time, just keep that in mind and you can contact your account manager and get that information for AFS. So a couple other things we're going to go through on the participant side of how a participant can get money out of the plan. And we're going to go through the distribution basics first. And participants going to want to know how they can get money out of the plan, but generally we want the money to stay in the plan as it's for retirement plan purposes. But most plans provide several options for a participant to take money out of the plan if they meet certain criteria. And the first is termination of employment or retirement. So that is not optional in the plan. That's always an option for the participant when they terminate employment to be able to take a distribution and move that to either their new employer or an IRA, cash it out, however they would like to take that distribution. The next one we'll talk about is age 59 and a half, which is typically called an in-service withdrawal, a hardship withdrawal, and if a participant unfortunately passes away or becomes permanently disabled. So we'll go over each of those options. The first, again, is the termination of employment or retirement. The withdrawal forms can be provided to the participant prior to their termination date if you know about that termination date, but the distribution itself cannot take place until the termination date has passed. So just keep that in mind if a participant is readying to take a distribution for termination purposes. Also, most record keepers will provide an area on the form asking for a last contribution date. This date is specifically because a record keeper will not contribute or will not distribute the funds until that last contribution has been made. So for example, if a participant terminates employment today, but you have one last paycheck that's being paid tomorrow, and those funds will be deposited next week, that record keeper can hold those distributions until that last deposit is made. And the reason for that is so that a participant doesn't have multiple distributions. They will incur a distribution fee. So it's better to have them all consolidated into one distribution rather than having one processed today as of the termination date and then another small balance produced next week. Just cuts down on how many checks or ACH debits are occurring for the participant, but then also saving them on that distribution fee. And then, as I mentioned, the special tax notice, just make sure that you're providing that tax notice to the participant as well with their withdrawal forms. The next item here is an age 59.5, and again, called an in-service withdrawal. This is an option to have in your plan. It's not mandatory, but it's nice to have for participants who are readying to take, to retire. So at 59.5, they can be still employed by your employer and then take their funds and move them maybe to their financial advisor's IRA and use those investment elections for until they terminate employment. So they can take a full distribution after age 59.5, roll it to an IRA, but still contribute into your plan. It doesn't mean they can't contribute, just means that they're wanting to ready for retirement, move that money. And I say readying for retirement because that's really what the regulation was intended to do, but participant can take that distribution for any reason after age 59.5. It doesn't have to be because they're trying to get things sorted out for retirement. The next option is hardship distributions, and this is another optional provision for the plan, not required, but it allows a participant to be able to take money in the case of an emergency. There's a very specific listing in the regulations to why this money can be taken, and typically an employee will have to give documentation to show that they meet that requirement. That some of the reasons would be to prevent foreclosure and eviction from a principal residence, to pay for educational expenses, to pay for uninsured medical bills. Again, certain items that are in the regulations that allow for this hardship to be taken. You may have seen recently that there is a new option under the regulations for participants to self-certify their hardship. And what that means is that they could sign off on a self-certification saying they meet the requirement and not have to provide documentation. I personally am not sure where I stand on that at this time, because I feel like if a plan is audited at a later time, then you may be asked as the plan sponsor to provide that documentation. And I'm not sure if that audit is going to require the self-certification only, or in addition require that documentation. So I almost feel like it's worth it to just go ahead and get that information now instead of later that you may need to get it, because it may be impossible to get it later. Now, in saying that, some participants will not want to take a hardship if they have to provide documentation to their employer of why they need to take a distribution. So that's one benefit, is that you'd be able to help those employees who just don't want to provide too much data on why they need a distribution, and they can just self-certify that they do meet those requirements. Participants do need to be aware, though, that before age 59.5, there's typically a 10% early withdrawal tax, and so that will still apply to these hardship distributions. So it might not matter to them because they need to take that money out, but 10% penalty is a huge penalty if we can try to give them a different alternative on how to get money from the plan rather than taking a hardship. I didn't realize that there was a listing here for all of the reasons, but some of these I covered, but here's a full listing of items that are required under or available under the regulations to allow for one of the hardship distributions. After age 1/1/2019, there were some regulations that changed a few things. So if you're coming from another company and didn't know about these regulations, we've added this slide in here so that you can make sure that you're aware that a participant no longer has to take a loan first in order to take a hardship. They no longer have to stop contributing to the plan for 6 months. These were, again, old regulations that are not in place anymore. Investment earnings from deferrals are now available for hardship withdrawal, which were not before. Employer contributions may also be available for hardship distribution. This one is an option for you as the employer. So if you do not want employees taking employer money for a hardship, that's perfectly fine, and that can be written into the document. And so you would just be allowing them to take their own money out rather than the money that you guys are providing as a match or a profit sharing. And then lastly here, safe harbor contributions were not previously allowed for hardship withdrawal, but they are now if you so choose to make them available. Next, if a participant unfortunately passes away, those funds are going to be distributed according to the participant's beneficiary election. If there is not an election on file, then there's a certain hierarchy provided in the plan already to how that's going to be distributed. And the first is going to be for a spouse. That would be the first stop for those monies. If they are married, their spouse is automatically the beneficiary of those funds. If they do not want their spouse to be the beneficiary, the spouse must sign off on a consent that they are not going to be the beneficiary and someone else will be the beneficiary. So it's really important to encourage your participants to have this beneficiary election on file so there's no problems when a participant does pass away. Age 72 distributions. So these are minimum required distributions. And what this is the regulation requires for participants who are turning age 72 and are terminated in employment, required to take a certain distribution based on their account balance and how old they are. There's a table in the regulations to determine a factor based on those items, and the calculation is completed each year for those participants. I will mention that there are some new regulations. Secure 2.0 came out recently, and this is the biggest piece of legislation that we've seen in a while, and so there's a lot of things that have changed. And one of those items is the age 72 distributions. And some of you may already know these as age 70 and a half. They've already been moved from age 70 and a half to 72. But now in the new guidelines, that age is going to increase again to age 73 in 2023. And then years later, we'll go up to 75. So as people are continuing to live longer and work longer, this minimum required distribution is being pushed out further and further to account for those age changes. So in the next year, 2 years, just note that you may have some people becoming eligible for this, but some people that are delayed because of the age change. Quadros are qualified domestic relations orders, and these usually come up in the context of a divorce. So if you're provided with a domestic relations order, the rules are very complicated. So please, when you get that domestic relations order, provide that to your account manager so that we can get that to our distribution team and have them review it. There are certain requirements that need to be considered in the domestic relations order, and it's very specific in detail that needs to be provided. So we want to make sure that first it's a qualified domestic relations order, and once we've determined that it's qualified, then we can help separate the account to what belongs to your participant versus their spouse if they're divorcing. Sometimes this comes up in the context of children also, but almost always it's from a divorce. So just make sure that you provide that to us and not make that determination on your own, but to have us help make that determination, and then also help with the paperwork to split that account so that that ex-spouse can take those funds. Spousal consent. I know that years ago when I started in this industry, I'm not going to say how old I am and how long that's been, but most plans, I was surprised to see that spousal consent's not required for distributions, but maybe that was just my naivety from being younger when I first started this profession. But most plans do not require spousal consent. There are extremely limited amount of plans that do require spousal consent, and that's really in the context of an old money purchase pension plan that you may have had previously, or certain defined benefit plans. But almost always you're not going to have spousal consent that's required for distribution. A participant can fill out the forms on their own and submit them to you or the record keeper in order to take those distributions. But if you do have some of these limited reasons that spousal consent is required, it's really important to get that consent unless the distribution is less than $5,000. So just keep that in mind if your plan does have these special arrangements of money purchase pension money or defined benefit arrangement. Loans are available in the plan, but they're not required. This just offers another item for a person to be able to take a funds from their plan if they need it in certain circumstances. The loans are available to participants, but do not require documentation. So it does make it a little more popular than a hardship withdrawal because of that reason. But there are limitations on the amount that a participant can borrow, even though there's not a limitation on why they can borrow it. Borrowing from the plan is not a taxable event unless for some reason they stop making contributions or rather payments on the loan. And that's only going to be in the circumstance of a participant terminating employment. So those loan repayments are made through payroll deduction. And so that if a participant is currently employed by you, those payments should continue. The participant can't come to you and say, I just don't want to make loan repayments anymore. If they're receiving pay, then they're obligated to continue those loan repayments. But if they do terminate employment, they can either repay the loan in full or be defaulted on that loan, which doesn't have any consequence to them, I guess, on like a bankruptcy type of environment. It's just that they would need to be taxed on that amount of money that's still due on that loan. So it can be it could be a high tax amount that they owe, depending on how much that loan is still outstanding. So they do have the option to repay that in full once they've terminated. But a couple of rules to go over on the loans, again, not required, but a nicety to have in the plan. Participants may borrow the lesser of 50% of their vested account balance and $50,000. So if a participant has at least $2,000 in their account, they can take a $1,000 or more loan because the minimum loan available is $1,000. So again, they can take up to 50% of their account balance. So if they want a $1,000 loan, excuse me, if they want a $1,000 loan, they would need to have at least $2,000 in their account to be able to take that loan. Loans must be at a reasonable interest rate. Currently, the amount that is deemed reasonable is 2 percentage points over prime. And that's just to say that a participant can't go into a bank and take a loan with no interest. There's going to be some kind of interest associated with it. And 2% over prime is what is typically deemed to be reasonable at this time. That interest does go back to the participant's account. They're not going to be paying that to you as the plan sponsor or the record keeper. That does go back into their account. Loans must be repaid within 5 years unless it's a residential mortgage loan. So if you have a participant that's taking a loan for, I don't know, they want to consolidate some bills or something, they can take that loan for up to 5 years. But in the circumstance of maybe they're buying a house and need a down payment for closing, they can take a residential mortgage loan for more than 5 years. And so that would be up to 20 years that they can take that loan. So just to let you know that there is a difference between the time period for a participant to take a loan and for that residential mortgage loan, because it's out of the norm, that will require documentation. So that would be the only reason that a participant would need to provide documentation if it's a residential mortgage loan and they're taking it for more than 5 years. The loans are generally paid through payroll deductions on a post-tax basis, and loans generally become due upon termination of employment. We put the terminology generally in here because you can make elections in the document outside of what we provided here, but we don't advise to have that. We would always advise loan repayments be made through payroll deduction. Alternatively, you could have them give you checks each pay period to pay that loan, but then you have to worry about tracking them down and making sure their loan payments are timely, and it just becomes a nuisance. So through payroll deduction is what we would always advise, and to have that written into the plan document. And then when a participant terminates employment because their payroll deductions will stop because they have no more pay coming in, that's when the loan will be deemed to need to be repaid unless they decide to default on that loan. And they can make that option to default on the loan. Again, it's just a taxable situation, not something that's going to go through like a bankruptcy or something like that. There are fees associated for loans. There could be a loan initiation fee from the record keeper, and then also there could be annual or monthly maintenance fees from the record keeper as well. In addition, there would be a loan fee provided for NOVA. We do review the paperwork and make sure the participant is eligible for a loan and make sure that they have the correct documentation if needed. And so there is a loan fee from NOVA as well, but the participant would bear the cost for those fees. They would not come to the plan sponsor. We put in here the fastest way to get a loan. When participants want a loan, they want it right away. So we would advise to apply online if the record keeper allows that, and to also request an ACH debit instead of a paper check. So one more item that we have here is the annual calendar. We'll go through what you can expect each month. I probably won't go through all of these because some of these are duplicates, but you can see what's going on throughout the year and pull this calendar out when you ever have any questions on that. In January, 1099s are distributed by the record keeper no later than January 31st. So a 1099 would be the tax form that's needed for a participant to report their distribution that they may have taken on their tax return. January is also a month that you'll be submitting your year-end census information to NOVA. We do send out emails usually the first week of January, and those emails will provide you to the link to our web portal, and then you can enter that data securely on our web portal. Also in January is when the participants will receive their fourth quarter statements from the record keeper. And it's also an entry date. Christine had gone through a sample example of the entry dates for when a participant becomes eligible. If you have a semi-annual, quarterly, or monthly entry date, you will always have January 1st as one of your entry dates. So just be aware of those entry dates in your plan. And then let's see, February, we put that on here, is also still submitting the year-end census information to NOVA. There's a deadline that you'll see March 15th. This is a big deadline for refunds to be provided to participants for any plans that failed the ADP and ACP testing that we talked about earlier. So you'll want to submit your census data as early in the year as possible so that we can get those testings completed and then any refunds processed by March 15th. Typically, the record keepers will allow for those refund forms to be provided to them by just say March 1st, usually 2 weeks prior to the due date, so that they can also guarantee that it be processed. So it's a very short time period in order to get all that done. So if you could get that census data as soon as possible, we can guarantee that those refunds will be provided. So in saying that, January and February and even into March is a big time for NOVA to be operating on those testing results. And so we'll be working on those diligently. And you'll see a couple of these also have entry dates. If you have these different entry dates for your plan, just be aware of those entry dates. let's see, in April, a big deadline I want to show you is the deadline for age 72 distributions. When a participant is taking their first required minimum distribution, that first one will be due by April 15th of the following year, and every year thereafter will be by December 31st. So it's only for that initial year that a participant will have to that April 15th deadline. It's also a deadline for participants to receive excess 402G refunds. So when you have a limit under the regulations for 2023, the deferral limit is $22,500, and then $7,500 in catch-up contributions for those participants that are 50 years or older. So if a participant would exceed those limits, those refunds would be due back to the participant in April, or else there's a penalty to the participant for not taking those distributions by April 15th. In May, NOVA is going to start working on those government returns, those 5500s. Those 5500s are due by July 31st without extension. So as soon as we stop working on your testing and have that completed, we'll turn right around and start working on that government return so we can get it to you to review the draft a month before the due date so that you have time to review it and submit it. For large plans, we had mentioned the 100 participant threshold. If you are an audited plan with more than 100 participants, you will also be required to file an audit report with your 5500. And so we would advise that you get started on that audit and engage those auditors May timeframe so they can start working on it and hopefully get you a audit return to be filed with the 5500 by July 31st. Again, July 31st is the due date for 5500s not on extension. And then we'll move to July 31st. We had mentioned one of those notifications to participant is that summary annual report. If you are filing your 5500 by July 31st, you'll need to get that summary annual report to the participants by September 30th. Also listed here is NOVA is going to begin their mandatory cash out projects. So for participants who have less than $5,000 and are terminated, we can provide notifications to those participants that they have funds in the plan, and if they don't take those funds within 30 days, we can force them out to an IRA. And that $5,000 balance is actually going to be increasing with the new regulations to $7,000 in 2024. I was hoping that would be a little bit higher, but at least we got from 5,000 to 7,000. It's a good way to keep your plan clean and not have to track those participants for mailing mailing notifications to, and keeping track of them as they might become lost. If they've changed names or changed their address, then they become lost and you just keep getting stuck in this circumstance of having that participant hanging out there and paying fees on them. So it's a great way to keep your plan clean and get those monies moved to an IRA as soon as possible. Again, October is going to be your fully extended due date of 5500. So if you didn't file by July 31st, NOVA can prepare a 5500 for you. I'm sorry, a 5500 extension for you. And that extended due date would be October 15th. And that's very typical of audited plans. But again, if you get that audit started in the May timeframe, hopefully you don't have to worry about this extension. We had mentioned about the required minimum distributions. NOVA will pull reports for your plan to let you know who has reached age 72 and who we think might be eligible for a distribution, or required to take a distribution, I should say, not eligible. And we are looking for confirmation that those participants are either terminated or actively employed. And then we can provide signature-ready forms for you to be able to sign those and get them submitted so that they're timely distributed. Let's see, notifications. We talked about a couple of these notices. These 3 notifications are required to participants by December 1st, so you'll want to be aware of that. Let's see. Also, the summary annual report, if you have that extension for your 5,500, that summary annual report will need to be distributed in December if you have that extension. Plan documents, Christine had mentioned there is a penalty for not having plan documents executed timely for the amendments or the document. And so December 31st is typical deadline for those amendments. So make sure by December 31st that anything that you've provided for an amendment is done timely. And I think that is it for me. I know that's a lot of information, but if you had any questions and we weren't able to get to them today, I'm sure that they're being tracked. Yvette will let you know. And otherwise, we appreciate you joining us. I'll let you turn it over to you, Yvette.
Awesome, thank you. It doesn't look like we have any questions at the moment, so we will go ahead and close out. Just a few reminders, on your go-to panel, you will see a drop-down for handouts. You will be able to find today's handouts, a copy of the presentation, and also a brochure for AFS if you are interested. If you are not able to see these on your panel, you can email us and we'll send you those handouts. For CE, be sure to fill out the pop-up survey once the session ends. And for any other questions, you can email us webinars@nova401k.com, and we'll get those to the correct person for you. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you, Charlene and Christine, for your time today. And thanks again to everybody for joining. We hope you enjoy the rest of your day. Bye.
Bye-bye.